Hey, Tara. Good evening, everyone, and welcome. Thank you for taking your time to come out this evening. We really appreciate the fact that you want to engage and learn a little bit more about taxes, and for bringing such great energy. I don't know if it's the walking, as long as you're bringing great energy. I'm looking forward to a fantastic session today. Matt is one of the most inspiring, insightful people in the apartment, and one of those things that made a difference for Karen and I. So without further delay, let's get started, and Karen will present our speaker.
Yeah, so please join me in welcoming Matt Doran. He's a financial professional dedicated to helping advisors and their clients navigate some of the complicated tax landscape that we're dealing with today. And Matt focuses on tax-aware approaches that empower advisors to live smarter and more holistic financial advice. And so he has experience with Edward Jones and continues to deepen his expertise in tax strategy as he's currently pursuing a master's in taxation.
Done.
And an estate planning certificate at Villanova University's Charles Widger School of Law.
Wow.
So.
That was great.
Thank you. So full disclosure, I started my career as a 5th grade teacher, and you're going to see that tonight. I like to keep it at that level because I do know that if you aren't winning and you aren't having fun, you're apt to quit. And this is a game you got to stay involved in, right? You learn that when you work with kids. So we'll start the way we would start my 5th grade classroom, with a pop quiz. How far can a dog run into the forest?
Halfway.
Why is it halfway?
Because it'll be running out.
That's right, because after that it'll be running out. So that's the way I would start my classroom day, because I want to make sure everybody's paying attention. So now I have a real pop quiz for you. Not sure why we're not. There we go. So, all right, so I want to just impress upon you the importance of tax planning, and I'm going to give you an extreme example to do that, but the actual blocking and tackling of reducing your lifetime tax liability is a bunch of little things. I want to give you an example, and you can't answer because I know you got some history here. All right, so if I've already used my exemptions, you know this lifetime exemption amount that we have, which is currently about 14 million, be 15 million in January. If I've already used my exemptions, and I want to give or leave $1 million to a grandchild, and I don't want the grandchild to pay the tax on that gift, how much tax will I pay? I want to make $1 million gift to a grandchild, and I don't want them to pay the tax, and I've already used my exemption. $960,000 of tax to give away $1 million in a gift. So let me unpack that for you. And one of the points I want to make is giving during living has a lot more power than giving afterwards, but the reason that that's the case is because once I've used my exemption, now I have to pay gift tax, which is 40%. So 40% on the million is $400,000. But who am I giving it to? I'm skipping a generation. And that law was put in there to backstop the estate tax so that people don't avoid the tax by giving it to their children and then having it passed down again. So if you go around the generation in the middle, if the person is 2 generations below you or more than 37 and a half years younger, you pay a generation skipping tax, which is also 40%. So it's 40% on the gross, not the net. So it's another $400,000. Now, in this case, I set it up this way on purpose. Under normal circumstances, the grandchild might receive the $1 million and pay the 40% GST tax out of the $1 million and wind up with a net amount. But I told you I didn't want the grandchild to pay the taxes. So if the grandchild doesn't pay the taxes, I need to pay the taxes. And if I do that, what have I now done? I have made another gift. I made a $400,000 additional gift to pay the taxes, and I will pay 40% on that. So 40% on gift tax, 40% on generation skipping tax gets you to 800, and then 40% on the additional gift is another 160, and I've paid $960,000 of tax to give away $1 million. So that's just one really concrete example of why planning matters. Okay, you've worked hard. And I gave a talk like this recently in Delaware, and I started like this. I didn't do the dog in the forest, but I should have. I said that having money is a job, and the IRS is your business partner. Okay? I actually believe they're quite a good business partner, and I'm going to convince you of that before we're done here. But if you don't pay attention to the partner, they're not that friendly. Okay, what I believe personally, I'll give you a little background. I didn't have tax problems when I was a 5th grade teacher, but I still was the guy on the first day of Christmas break who raced to the post office. You know how we used to get the publications there? I raced to the post office to get publication 517 and a 6-pack at Rite Aid, and I spent the next 10 days of Christmas break figuring out how to save money. But I love tax planning because this is an area in which you have way more control than you probably realize. And the opportunities in tax planning, they renew and expire every year. So when people ignore their opportunities, they lose efficiencies, right? It's an active sport. So I'm going to give you a little bit of background on why that's the case. But before I do, I want to show you my biases. The tax laws, in my opinion, are not constraints. They're incentives. And if you look at the tax law through the eyes of it being a book of incentives, it's saying do more of this and less of that. Do it this way instead of that way, and you will get rewarded. For example, are we incentivized to be married in this country? Why? How? How does it play out?
The tax brackets, they're wide.
Even if only one person makes the income, right? The brackets are twice as wide, even if only one person is making the income. It could have just as easily been assigned to each person, which would have meant that one person, if there was only one wage earner, they would have moved through the brackets faster, right? So that's one example. Are we incentivized to own homes in this country?
Yes.
In a multitude of ways. What are they? You get to deduct the interest, right? Your basis is set on the purchase price, even though a lot of it's borrowed money, right? So you get to deduct the interest, you deduct the property taxes.
Exemption when you sell the house, and if you're married, you get twice the exemption when you sell.
That's right. So capital gains exclusion, and for married filing jointly, it's $500,000. A lot of wealth in this country has been built by going into a starter home, moving up market, and doing that multiple times, and building a lot of wealth that never got taxed. Okay? Are we incentivized to hold our investments for longer than a year?
Absolutely.
Absolutely. Are we incentivized to start businesses?
Yes.
Yep. The one I want to unpack there is called bonus depreciation, and I want to tell you where and when it was born. Because it just got renewed on July 4th at 100%. It was already in the system, but it was going down in terms of percentage. Bonus depreciation is a tax tool that allows a business owner, when they put equipment into service, to write off the entire cost of that equipment in 1 year if its useful life is 20 years or less. Right? So think cars, computers, drill press, whatever, lots of things have a useful life that's shorter than that period, and that is called accelerated depreciation. You know when that was born? And the point that I'm making now is that tax law stopped being primarily the mechanism to collect revenue for the operations of a central government decades ago. It does that, of course, but it also distributes aid to people in the form of refundable credits and all kinds of things. But more than anything else, it is an economic driver of activity and an incentive for behaving in certain ways. It was born, bonus depreciation was born in a piece of legislation in 2002, January, backdated to September 10th of 2001. Why? The World Trade Centers went down, and nobody knew how long that situation might be in place. And the fear was that it would create deflation and no business activity. So tax law comes to the rescue and says, we're going to do this thing called bonus depreciation, replace your trucks, update your fleet, do everything you can do, and you'll be able to write it all off in 1 year, and it will keep people employed. Does that make sense? So once you start seeing what is being incentivized, it feels a lot different. And I'm not a political animal at all. I'd rather never talk about it, honestly. But the current administration is unwinding a lot of the incentives that the prior administration put in place. Green energy credits and various different things. I don't have a dog in the fight. But it's very hard to come away from reading the One Big Beautiful Bill Act and not conclude that it's not pro-growth. It is pro-growth, right? So bonus depreciation gets restored, qualified business income deduction, which I never would have thought was going to get extended, is in the law. Pass-through entity tax to help people with pass-through businesses pay their state tax through the business instead of being capped by the state and local tax cap that we've all endured for the last 10 years. I mean, there is pro-growth stuff everywhere in that law. And I think the advantages for individuals are really, really exciting, but they're also very exciting for business owners. And that's because that's the heartbeat of our economy, and it's where job growth lies. It's not big companies anymore, right? I used to live a handful of miles from the international headquarters of Dow Chemical. And that place just keeps getting smaller, right? It's not the big companies that are providing jobs. All right, so let's talk a little bit about history that got us to why I believe that tax planning has become absolutely vital in wealth management, and most people aren't getting it. Who do we believe does tax planning?
CPAs.
And they don't. They don't. I'm not picking on CPAs, they don't do tax planning. The reason, and I have two sisters who are CPAs and they would struggle to spell tax with each other's help, but that's not because they're not smart. They're really smart. One was the payroll officer for the state of Michigan, and the other is the controller for a string of assisted living facilities. They're incredibly bright people, but tax is not their thing. One is audit and the other is accounting. Okay, tax is a massive space, kind of like investments is. I'm not going to tell you chapter and verse how oil and gas partnerships work, even though I'm an investment guy. It's a massive space. And a lot of people aren't focused on tax, even though they're in that space. And accounting firms operate very similar to law firms in that a lot of the work gets done down here and it rolls up for approvals, right? So when we as wealth managers know that you did a qualified charitable distribution from your IRA, we're the vanguard to make sure it doesn't get missed and treated as taxable on your tax return, because it often does. Make sense? Accounting firms, again, they're some of the smartest people I know and some of my best collaborators. But have you ever had this happen? You call the person and you say, hey, you know, I was reading this, or I heard that, or I was talking to so-and-so, and I was wondering if we could do this. And then that person says, well, you know, that's a good idea. and you're thinking, well, Weren't you supposed to be telling me that? And I'm just illustrating that's generally not the role they play, okay? It's slim margin, high volume, certainly good resource to bounce questions off of, but when people think that they're gonna be turning over every stone to reduce the liability, it's just not what happens there, okay? And it seems like maybe you've experienced that. Okay, so a little history lesson about why tax planning matters now so much when maybe it didn't all that long ago. And I chose these dates because they perfectly represent basically a full working career. But in 1985, which was 40 years prior to today, full working career, over 80% of private sector workers who worked for medium and large companies had a pension. And we know it's higher for public sector, right? So 80% of people in medium and large companies had a pension. And if you throw in the smaller companies, it's more like 50%, but it was still very high. That percentage today is sub 15% for medium and large. And even public sector workers don't have pensions all the time now. My sister, who was the payroll officer for the state of Michigan, first wave of people who had no pension, which is historically one of the reasons people go to work in those jobs, because of the security of the benefits. Does that make sense? So what happened was one phenomenon, which was life expectancy ever increasing, collided with another phenomenon, which was 30 straight years of interest rates going this way. And it's led to underfunded pension plans, because very difficult to pay somebody until they die if they might live to be 100. And of course, the fixed portion of the portfolio wasn't earning anything. Remember when interest rates were zero? It's very hard to do a defined benefit, which means we're promising an outcome, versus a defined contribution where we know we can quantify the money we're putting in, right? So seemingly overnight, but it was really one generation, seemingly overnight, all of the responsibility for planning for retirement income, retiree health care, needing to own more investments, more account types, how to withdraw from it without running out of money, not to freak out during a pandemic or other global events, was shifted from the actuarial population and the finance population to the individual. And it just changed everything, okay? So what you saw at the same time, and it wasn't born then, but it wasn't very prevalent until then, was the introduction of performance-based and incentive-based compensation tools. A lot more restricted stock units, non-qualified stock options, incentive stock options, preferred shares, non-qualified deferred comp, signing bonuses. That's, employers said, hey, we can't promise you a benefit at the end, but we can attract and retain top talent with other tools. And in my opinion, a few things happened as a result, almost instantaneously. One was that a lot of complexity was born. People prior to that didn't have a lot of complexity. So I'll give you an example of that, and then I'll come on and tell you what the other things that were. But in just a generation and a half ago, you had people who worked later into life, and by the time they retired, their house was paid for, their children were on their own, and they were closer to collecting Social Security, right? Maybe not right there, but they were closer because the age was also lower, right? And so if those folks had a tax-deferred retirement plan, what coincided with their retirement was their expenses dropped. And they were so close to external sources of income like pensions and Social Security, and the mortgage was gone, that they didn't need to tap into the money they had saved. Does that make sense? Okay, and they didn't have all these performance-based tools. So if I had a pension, what kind of income is it? It's called ordinary, right? Ordinary. I have Social Security, which isn't all taxable, But what kind of income is it? It's ordinary. And interest rates were higher, so I was a credit union member, had CDs at the bank, which is what kind of income? Ordinary. And then when I draw money out of the retirement account, what kind of income is it? Ordinary. It's ordinary. And I'm telling you right now, the order of withdrawal is wrong. It was more right in the past, but it is not right now. And I'll explain that. If all of my income sources are ordinary, and some of it is deferred, there's definitely an incentive to keep deferring it. But if they're not all ordinary, my withdrawal strategy has to be dynamic to manage the confluence of taxes that result from eclipsing certain thresholds. It used to be taxable first, tax deferred second, Roth last. I don't believe that. And I believe that probably some of you in the room are deferring too long, because I do this all day, every day. And I review tax returns all day, every day. So I know that people are deferring too long, and it will result in paying more tax in most cases. That make sense? So the order of withdrawal. All right, second thing that happened though, low interest rates supported a lot of things that we now see as normal. Bigger houses, second houses, rental houses. Make sense? We had an extended period of very low interest rates, a lot of wealth built in real estate, and a lot more real estate holdings. Probably some of you have holdings, real estate holdings in more than one jurisdiction, more than one state, right? It's pretty common now. And then the next thing that happened, sort of a knock-on effect, is if working at Dow Chemical isn't my dream come true, and they're not going to pay me retiree income or give me retiree health care, I'm incentivized to invest in my own skill set and do what? Change jobs. Start my own business. So you started to see the need for more education, which then meant family formation happened later. It often happened with debt. Low interest rates on mortgages meant debt being carried into retirement, et cetera, et cetera, et cetera. And then you saw mobility in the workforce because of all the things I mentioned. That recipe that I just built for you is why tax planning now is absolutely vital in wealth management. Because there's multiple tax treatments, multiple account types, different income sources, and timing issues. And when you put it all together, it's a puzzle that can be solved, and it can significantly reduce the tax bill if it is solved, but the taxes could be a lot higher if it's ignored. Does that make sense?
Yes.
I'm going to show you some evidence of that, but before I do, any questions?
What did you just say?
All right, let me show you. I might need Karen's help here. I want to show you something. If I knew I'd need it. Okay, when I'm talking to advisor, and by the way, while she's logging us in, my job at And Partners, Guident Wealth, of course, is a practice within And Partners. And Partners is the parent company, and I work for the parent company. I lead the advanced planning area, which means tax planning, charitable planning, and estate planning strategy. That's what I do. Can I just X this? Okay. When I'm talking to advisors who haven't been allowed by their prior employers to work on tax-related items, or if I'm talking to clients who I don't really know what they know, how conversant they are in tax, I always start with the brackets because I don't think this is really well understood. So forgive me if you're one of the people who knows it very, very well. But there's two sets of brackets. That, first of all, isn't always known. And what I want to point out about this set of brackets, which is the ordinary income bracket, what we were talking so much about a minute ago, what I want to point out about it is that the brackets aren't uniform. And what I mean by that is we all start out at 10%, but it's kind of a token. There's not a lot of money tax there. And then we move on to the next bracket, which is only a 2 percentage point change. But look at the next one. It's a 10 percentage point change, right? And that one needs to be managed, especially by retirees. So let me go a little bit further and I'll show you what I mean here. So not only are the brackets not uniform in terms of how they move, 2 percentage points, then 10, then 2, then 8. Those are big changes. And at a bare minimum, the threshold right here and right here need to be managed. Now, they're most easily managed by retirees because of the nature of how they're drawing their income. And that's why I said it needs to be dynamic to manage it. Does that make sense? All right, because I mean, I was a financial advisor for a lot of years, and somebody would come to me in November or December and say, well, you know, we knew that car was going to go, and we need money for a new car, and it's December. And I'm going, I can see the next tax year. I mean, it's right there. And if we only had one place to pull it from, it can result in paying more than you need to, okay? The second thing I want to point out is that the amount of money taxed within each bracket is not uniform. It's very small in the first bracket, 24 grand, then roughly 73 grand, then about 110, but they get wider as we move higher, and it drags the weighted average along with it. But the worst thing on the screen, and this is happening a lot to people, the ones that I described, because they didn't need to tap into their retirement savings. Let me scroll back up here and show you what I mean. You'll notice that the married filing jointly brackets, as Karen said earlier, are twice as wide as the single. So exactly double, exactly double, exactly double. And at the upper brackets, it's not that way. It's not exactly double. But the married filing jointly brackets are twice as wide for the most part. And what happens is that couple that put away a lot of money pre-tax, it was put away by a couple for a couple, but they didn't need to tap into it right away, and they don't. And at some point, someone dies. When one member of the couple dies, the following year, the surviving spouse is a single tax filer. So the same money that was put away by the same people for the same family could wind up being taxed much more heavily because you're going to go through the brackets twice as quickly, but that's not all. The standard deduction is half as much. The net investment income tax threshold is lower. The IRMA adjustment on how we pay for Medicare is half as much. And there's a whole bunch of knock-on effects that happen when that income is distributed to a single tax filer compared to married filing jointly.
Same with divorce.
Yes. So is this making sense so far? This is what we call the widow's penalty. All right, so historically, we said spend your taxable account first, then tax deferred, and then Roth. And what I'm encouraging you to do is revisit that thinking. It's not like no one should do that, but people with very large pre-tax balances have to think differently about it now because of a second change that was made, and a third one. The second one was that the required minimum distribution age, which used to be 70 and a half, got changed by the Secure Act in 2019, and it went from 70 and a half to 72. And then Secure 2.0 changed it again to 73, and for anybody who's born in 1960 or later, the RMD age is 75. So for people who are obviously clients of wealth management firms, they are typically the ones who don't need to access that money. And I said this to Karen earlier. If your TV works on rabbit ears, when are you going to change it?
It doesn't work.
When it doesn't work anymore. So if somebody doesn't need to tap into their tax-deferred retirement account and they know that doing so is going to cost them tax dollars, they don't. But here's what happens. An extra 4.5 years of growth means bigger balances and shorter life expectancy because the onset is later. What does that do to the distribution size?
It's bigger.
It's bigger, okay? So that's the second main thing is I am not a fan of the RMD age going up. People should be accelerating money out of tax deferred. because tax deferral is a wonderful thing in the accumulation phase of life. But it has diminishing returns when life gets shorter. And the third part that made that a certainty was that Secure Act also changed how those assets are inherited. All right, so it used to be before Secure Act, if I inherited my dad's IRA, I could stretch its distribution over my life expectancy. So if he had $1 million in an IRA and I was 55 and inherited it, my life expectancy is another 30, 40 years. I would be required to take distributions over that period, and the tax hit would be relatively minimal. But now it's 10 years unless you're a spouse or you fall into some other special categories. So with a 10-year distribution period, and I use my dad as an example because he passed away at this time last year, and I'm 58. Both of my sisters are CPAs. You think we're in a higher tax bracket than my dad was?
Yeah.
Absolutely. So I was aggressively converting his IRA to Roth IRA. You can only do so much at a time or I'm going to increase his tax bracket dramatically. So I'm topping off tax brackets, right? But then he passed away. And I was telling my parents about the widow's penalty 5 years ago, like, guys, I mean, my parents could live on nothing. And I'm saying, but you don't need to spend the money. You need to get it out of a tax deferred environment. And then my mother passed away suddenly without warning. So all of a sudden now we have a single tax filer. And then a couple years later, like often happens, my dad passed away. So the point is, first and foremost, starting later means bigger balances and bigger distributions. And at some point, someone's going to pass away. And if there's money left in the account after they pass away, it's going to be distributed over a very short period and potentially to someone who's in their highest earnings years. Right? Is all that landing with you so far? Okay. I know it's landing with you, Susan, because you do this every day. All right, let me show you a second set of brackets now. This is my favorite one. And my favorite rate within this one is 0. So in this country, which is one of the reasons why we are the epicenter for financial things around the globe, is that capital is treated very, very well in this country in the form of companies need to raise capital to grow, expand, employ people, and build out, what they've created. And investors make that capital available to make that happen. And for the risk that we take on capital, then we get better tax treatment. There's only 3 tax rates in the capital gains brackets, the second set of brackets, and the first rate is 0. That's a pretty good one. I'd like to pay tax at that rate whenever I can. But even the top rate in this set of brackets is only 20. And this is what Warren Buffett meant when he said 15 years ago, I like Warren Buffett, but he's kind of cryptic and I didn't appreciate this comment because of what it led to. He said publicly that his tax rate was lower than his secretary's. And what he meant was his income comes from capital. And the top rate in these brackets is 20%. But people misinterpreted it as him saying he paid less tax than his secretary. That's not what he was saying. What he was saying is, remember, it's incentives. Make capital available for the growth of the economy and everybody wins. That's why. All right, so what I want to point out here, because this is certainly relevant for some of you in the room, these numbers on the brackets, both in this set and the previous one, are taxable income, not total income. So all the deductions are already out. And if you had, for example, tax-free bond interest, it's not in the number. So is it possible for retirees in middle America, let's say, not living in a gigantic city, is it possible for retirees to have taxable income of $96,000 a year and be living really, really well? I think it's quite common, actually. Very common. And because it's possible to do that, once again, not tapping into retirement accounts because we don't need to, we miss an opportunity of being in the 0% tax bracket for capital. All right, so let me give you an example here. Let's say I have a couple that's got $50,000 of pension income, $50,000 of Social Security. I know it might be more than that, but I'm just using round numbers. Social Security is not all taxable. The maximum is 85%, right? So if I take 15% off of 50 grand, I'm somewhere around 43, okay? So I've got 50,000 of pension, 43 that's taxable from Social Security, but I haven't taken off any deductions yet. So that's, what am I at, 93? I'm at 93, and then I take off a standard deduction for people over 65 that's at least 33 grand. Now I'm at 60, and the law just changed to provide a new senior enhanced deduction, which is $12,000. Now I'm at $48,000 of taxable income. Even though my income is six figures, okay? What I might consider doing in that environment, here we go, is recognizing capital gains because I know they're going to be taxable at 0%. Let that sink in for a minute. If I own stocks that pay dividends, or I sell a stock that is appreciated, if it's long-term capital gain, it's taxable, but it's taxable at 0%. So I've been having this conversation for the past couple of years about NVIDIA, and CoreWeave, and several companies that have done, a lot of companies have done really, really well. And sometimes people get married to a stock because it's done so well, but the other reason that we get married to stocks is because we don't want to pay the taxes on selling them. But people are not always aware that they wouldn't have to pay any tax if they sold it, right? It's our job to help them see that. And then the second order of that discussion is, well, but I love NVIDIA. Like, I love NVIDIA too. But if I told you you could sell it and have it taxable at 0%, what could we do then?
Wait a little while, buy it again.
Don't even wait a little while. You don't have to wait. There's only a wash sale rule on losses. You can buy it right back and reset the basis at the current market value, right? So when it comes to thinking about where income needs to come from, order, amount, timing, source, the financial advisor is the one that's sitting at the table in real time. The CPAs who I like to pick on are actually at a tremendous disadvantage. They see things after they happen. That's just not fair. It's not a fair fight.
True. Yeah, they don't have the information.
They just don't know, right? But the advisor does. And I used to, when I was a financial advisor, I always asked people to bring me their statements, of course, because we were very investment focused. But many, many years ago, I changed that. I'll look at the statements downstream. The first thing I always ask for is the tax return, because the tax return tells me things that the client can't tell me or wouldn't think I need to know. The beneficiary of a trust, they put a truck into service in their business had a net operating loss, they're carrying a loss forward from some trades they did before, they own rental properties that are fully depreciated, they gave cash to charity. Like, I need to know those things because all those things present opportunity. Make sense? All right, so let's go on to the tool. I'm going to sit for a minute so I can show this to you. We use a tax planning software. This is really not so much about the software, but I do want to show it to you because I think that a lot of the work that knowledge workers in general do, not just us, but knowledge workers in general often experience that other folks don't always understand exactly what they do, right? It's hard to make it tangible. And so I want to show you what happens when we collect somebody's tax return. This is a made-up example because I wouldn't ever use real data. When we take somebody's tax return in, I review it, the advisors review it, many times we're reviewing it together I'm helping them see where the vital signs are and where the opportunities are. But at the end of that process, we kick out this tax report and give it to the client. And this tax report allows us to become educators to the client about the moving parts in their tax life and where the opportunities lie. So let me give you an example. This is why I spent so much time on the brackets. All right, so in this case, we've got Peter and Paula professor. Peter works for someone else. Paula is self-employed. So what's represented here as their total income has already been reduced for pre-tax items that happen at work. But then it got reduced a little bit more because Paula has self-employment income, and you get to deduct the employer side of self-employment tax, which I'm sure you're familiar with if you own businesses. I can see here they took the standard deduction, and I got down to, they made $229. Remember, it was north of that if they put money in 401k or HSA or whatever. But the taxable income got down to $193, and this is important because this is where it splits. We have taxable income of $193, but we have two types of income, right? So what I want to show you here is up here, the qualified dividends, which is a subset of ordinary dividends. These are the ones that get long-term capital gains treatment. And of course, their capital gains, short and long, the long-term ones are the ones that go through the second set of brackets I showed you. So about $34,000 of their income that's part of this 193 goes through the second set of brackets. Let me show that to you. Their first set of brackets, like I said, they paid 10% on some of it, then 12, then 22. But the 22% bracket ends at 178 of taxable income, and they only put 159 through the brackets. Because the other income that they had landed down here, that $34,000 was capital, remember? That's taxed at a lower rate, so that might mean we want more of that, right? Okay, back to the upper brackets though. If I could talk to somebody, and these folks are in their mid-50s, if I talk to somebody about tax rates are historically low right now, the biggest risk is policy change that takes brackets higher. You probably know the country has quite a lot of debt. If rates themselves move higher, we might look back and say, gosh, I could have recognized income at 22% and I should have, right? This little air pocket that's shown over here on this graphic is showing how much room I had left in the tax bracket that I'm already in. I'm not necessarily saying pay a higher tax rate. I'm just saying I'm already in this bracket, so what might I do with it? You either do a Roth conversion or a withdrawal here, right? So let's talk about withdrawal, because people always talk about conversions, and I'm a huge fan. But when I was converting my dad's stuff, this is exactly what I was doing. There was a little self-interest involved. I knew I was going to inherit it. And if it's in a Roth IRA, I can let it sit there for another 10 years and all the growth is tax-free, and I can leave it sit there for 10 years. I don't need to draw it. So that was advantageous for my sisters and myself. But all tax planning is a trade-off. When you have money in a tax-deferred account, no matter what it's invested in, what's the treatment when it comes out? What kind of income? Ordinary. Even if what it's invested in is capital. So inside an IRA, if I own stocks, I own mutual funds, which would ordinarily be dividends and gains taxed at a lower rate, not so. But if I withdraw it from the IRA and it's in my brokerage account, then that happens. So all I'm really saying is, this is an opportunity to fill up a bracket that someone's already in, and it's an opportune one because it's not that high. Okay, so we'll go a little further. This is certainly good that their taxable or their capital gains and long-term dividends were taxed at 15%. Now this client is not old enough for Medicare, but I always put it on here because I want to teach about it. And if any of you are on Medicare, this is one of the things that irritates people a lot. And it's called IRMA, which stands for Income Related Monthly Adjustment Amount, key word being monthly. I call it means testing. So this is a little bit old. I'll give you the current numbers, but If a married filing jointly couple has modified adjusted gross income, which really means all of your income, including tax-exempt bonds, which aren't taxable, but they still hurt you on Medicare. So if a couple is under the first threshold, which is now at 212, they pay a base premium for Part B, which is now 185, and D is included. But if they go over that threshold by $1, 206, it's now 12, but $212,001, then they pay the base premium, which is now 185, and a surcharge, which is now 75 bucks. $75 extra per person per month, and D is not included anymore. So $75 per person per month is 150 bucks a month. And I won't even factor this in because the math is too hard for me, but that's $1,800 for going over by $1. Calculate the tax rate on that $1 overage. So what happens here, and I hope you all pay this for Medicare, honestly, that means you have really high income and you always do. But what really happens for our clients is their income spiked for some reason. They sold a rental property, they took a big withdrawal to remodel the bathroom, buy the Winnebago, whatever it might be, take the 50th anniversary trip. Or they inherited an IRA and it forced income upon them, that over a short distribution period, and they wind up with the knock-on effects of tax here. And the reason why it irritates people more than most of the stealth taxes do is because you don't get better Medicare for it. It's the same Medicare. You're just paying more for it. And the other thing is that it operates on a 2-year lag. So if anybody in the room's on Medicare now, either within the last couple days or the next few days, you're going to get a letter from the administration saying, here's your new premium amount. And it starts in January. But what I want you to know is the tax year that we're in isn't over yet. So for the premiums to be adjusted in January, what do we have to rely on to calculate it? The most recently filed tax return, which is 2 years prior to 2026. The 2024 tax return drives the 2026 premiums because of the timing issue, right? So often what happens, and you'll remember a few years ago when inflation was really high and the news was constantly saying, oh, retirees are getting a big boost in their income this year, 7% raise. I had clients coming to me and saying, mine went down. The reason is that the Medicare premium is taken out of the Social Security income. And even if the Social Security income went up, but they had an IRMA adjustment, they netted less money. Make sense? So managing thresholds has become really important. And we do that by smoothing income. First of all, getting money into the Roth IRA environment protects people from the widow's penalty because withdrawals from a Roth IRA don't count in the MAGI calculation. And at some point, someone's going to pass away. But the other thing is it's a better inheritance, right? That person, myself included, can let that money sit for 10 more years and it's all tax-free growth. So when somebody asks me, should I do a conversion, I want to make sure I state that it is not a panacea. Roth does not make money grow differently or better. I'll prove the point. If I had $100,000 that got invested with no tax, so call it pre-tax, if I could put $100,000 in pre-tax and it doubled, it's worth $200, right? If instead I did Roth contribution, I paid 25% tax up front, I'd have 75 to invest, right? I paid the tax on the front end. And it doubled, I'd have 150. But remember, the first one that doubled, I haven't paid the tax yet. So if I pay the tax on 200 at 25%, where does it take me? 150. They're both 150. There is no mathematical difference unless there's tax arbitrage. I have to pay the tax at a rate lower than I would have withdrawn it for that to be positive delta. In fact, if I pay the tax at a rate higher than I would have later, I got harmed by it. But when somebody tells me this money is definitely not for me, It's for my children. Then we strategically try to get it into a Roth IRA because it's a much better inheritance. Does that make sense? And we're just topping off tax brackets. All right, so we'll go just a little bit further. I've been talking a long while now. We're going to give you this report. If you want us to do this for you, it's going to show you all the calculations for various things. It's going to give some details on what credits and deductions you had, but it's going to kick out some observations that are system generated that say, hey, you're within 10% of triggering another tax called net investment income tax. We might be mindful of this. Or we saw HSA distributions, but if you archive receipts and keep the money in there, you'll get more benefit from doing it, and so on and so on. So this is really helpful for the financial advisor to have conversations about what's happening in your tax life and show you some opportunities. Now, I created two scenarios that I want to show you, and then I'll come up for air, I promise. This one is called No Federal Tax Due, and it's based on real people, but this scenario is fake. I had some clients that I had sold some stocks to 20 plus years ago, Honeywell, Illinois Tool Works, Waste Management, Home Depot. I went away into management. I was gone for many, many years. I came back and started a new company of my own, and they came back to me as clients, and they ended up bringing in their statements, and the same stocks I had sold them 20 years earlier were still in their account. They did exactly what I told them to do, buy and hold, right? And they had $500,000 of embedded capital gains in those 4 stocks. So we set about to how can we unwind these positions because they're large and pay the least tax. So that's what this scenario is about. It's called No Federal Tax Due, and it's made up, but it's based on them. So here's the deal. These two folks worked at Dow Chemical, and they were both retiring. They had pensions, which is ordinary income. But at Dow Chemical, you can defer your pension. It has an escalator clause on it, kind of like Social Security does. So you're not really harming yourself. If you delay it, you're going to get a little bit more, right? So the goal was to keep ordinary income out of the equation so that we could unwind these stocks. So this is a typical scenario if somebody's got, significant wealth. They had some tax-exempt interest. They had qualified dividends of $50,000, which could easily be a $2 million portfolio. I did an IRA distribution at this time. They didn't need it, but it was actually a conversion. And the reason I did it is because people believe we start the tax year at 0, but we don't. Why not? We start the tax year below 0 because everybody has at least a standard deduction, right? And deductions go first against ordinary income. But in this case, they also had an HSA. So the amount of money they contribute to the HSA plus the standard deduction, we knew would be wiped out. We could recognize that amount of income and it wasn't going to be taxable. So we did a conversion of that specific amount. And then we layered in some capital gains to engineer to be in the 0% tax bracket. Now, a $39,000 capital gain could easily be, I bought Apple for 40 grand and now it's worth 80 grand and I'm going to sell it. I'm going to free up 80 grand, but only 39 of it is capital gain. The basis doesn't count as taxable income, right? So let me show you what happened. In this scenario, their income was 6 figures, 125.7. That was the HSA at the time. Got them down to adjusted gross income of 117. They took the standard. Taxable income was 89,250, and their total tax was 0. A 6-figure income and no federal tax. Last week, one of the practitioners I was teaching this to said, hey, Matt, could you send me that no federal tax thing that you showed us? Like, I want to show it to my dad because he doesn't believe it. He's a CPA. So let me show it to you. What happened here was the only ordinary income in the equation was the conversion we did. That was offset by the HSA and the standard. So no money actually landed in the first set of brackets at all. All of it landed in the second set of brackets because it was dividends and capital gains. And at that time, the 0% capital gains bracket went to 89,250. And so that's what we recognized. And it was taxable, but it was taxable at 0%. okay? So in cases like this, you're always faced with a trade-off. If somebody has room in the 0% tax bracket, it also means they're in a low ordinary bracket. And the question is, should I recognize gains for free, which is a one-time event, or should I use the space that I have to convert money from my IRA to a Roth because it's cheap to do it? And it's always going to be a trade-off. What might happen is people do one or the other or a little of both, or they do different things in different years, right? So that's the whole premise of everything I'm telling you, is that it's dynamic. It needs to change, based on changing scenarios. All right, here's another quick one. This is where I'm trying to emphasize that money has an order to it. And I named these clients Mr. and Mrs. Say What, as in like what just happened. Okay, so here's the scenario. This is a couple that has $60,000 of wages and $60,000 of long-term capital gains, because remember, qualified dividends and capital gains have the same tax treatment. So $120,000 of income, and it's 50-50. What ends up happening here is they have $120,000 of income. They take the standard deduction. Their taxable income is $92,300. Their tax is less than $4,000. Think about that. $4,000 on $120,000 of income. It's really, really low. I want to show you why, and then I want to show you where a mistake sometimes gets made. So remember, I said that, okay, they're in the 12% marginal, their average rate is really, really low, but half of their income came from qualified stuff. And I said to you that deductions go first against ordinary. So they had $60,000 of wage income, but they took a 27.7 standard deduction. That's going to hit that first. And that's why this number winds up being 32.3. The other income that they had was capital, and a lot of it landed in the first bracket. Almost $57,000 of their capital gains and dividends were taxable at 0%. So in the first bracket, the deduction wiped out income. In the second bracket, the zero wiped out the liability. And so in both places, they wound up paying very little tax. That's what happened. So to skip to the punchline, this is where somebody often says, well, maybe I should do a Roth conversion. I'm in a really low tax bracket. And I would say in this scenario, don't do that. Because capital gains are likely not going to repeat every year. Dividends are, but capital gains probably won't. So I created this scenario right next to it where I could show you the only variable I changed was a $10,000 Roth conversion. Everything else is the same. So we're going to get down here and we're going to see that my taxable income went up by 10, exactly what you'd expect. Standard stays the same. Taxable income up 10, adjusted was up 10, taxable up 10. But my tax bill goes up by $2,700. So if you do the math, the only additional income I recognized was $10,000. Why would I pay $2,700 in tax? Isn't that 27%? I'll show you why. Because money has an order to it. And ordinary income sits at the bottom of the equation. If ordinary didn't sit at the bottom, it would be impossible to have a 0% capital gains bracket. It has to sit on top. But when you introduce more ordinary income, it's like a layer cake, and you push things along. So remember, before we had 120 of income, now we have 130. Let's look at the first set of brackets. Didn't this used to say 32.3? Now it says 42.3 because I did a conversion, that's ordinary income. So I added $10,000 of ordinary income. What bracket am I in? I'm in 12. So I'm going to pay 12%, which is $1,200. But what maybe didn't get noticed was it had the effect in the second set of brackets of pushing some of those dividends that used to be taxed at 0 into the next bracket, and now they're taxed at 15%. So we had $10,000 of capital gain or dividend income that wasn't being taxed. But we pushed it along by introducing more income into the equation, and that meant $10,000 now taxed at 15%. There's the other $1,500. $1,200 and $1,500, $2,700, and it feels like you get taxed twice on the same money. Make sense? Can you tolerate one more example?
Yes, and then I have a comment, but go ahead.
Okay. So I built this scenario because One Big Beautiful Bill Act went into law this year. And it's not completely unheard of, but it's a little unusual when you have a tax law change that's effective in the year you're in. A lot of times the law's just going to change in January, right? But this tax law actually had some retroactive provisions, some things that are active now, and other things that don't get introduced until 26 and 27. But one of the things that's really helpful if you're 65 or older is there's a new senior enhanced deduction of $6,000 per person, but it's phased out. So you have to manage your income to remain eligible for it. And I want to show you where sometimes that gets missed. So this is just a made-up couple, Bob and Sue. There's some wage income, there's some tax-exempt bond interest here, there's some taxable interest, there's some qualified dividends, and then there's a spread between qualified dividends and ordinary dividends. Let me tell you what that always is. If you have ordinary dividends that are bigger than your qualified, there's either a bond fund or a money market. A lot of us use money markets. If it was at the bank, it would be called taxable interest. But if it's a money market fund, that's a mutual fund, and the interest we earn there is called a dividend. It's just ordinary dividend, okay? So I'll tell you a quick story. I was flown out to Kansas City earlier in the year to meet with one of our practitioners' clients, $15 million client who was turning 73. So what do you think was on his mind? RMD starts this year. So we end up having a big tax discussion, and in the course of doing so, I found out he had $4 million in the IRA. Well, RMD starts at 3.97%, so call it 4%. He's got $160,000 RMD coming. And he wasn't interested in giving any of it to charity, so he's going to have this income stream. But as we're talking through it, I find out he's got $5 million of CDs in a joint account. So in the current rate environment, $5 million of CDs is producing at least $200,000 a year in income. Okay? And I said, well, remember I taught 5th grade. I said, well, what if we just did this? He said, what the hell does that mean? And I said, well, what if the CDs were in the IRA? If we held the CDs in the IRA, the interest that they produce would become the RMD, and you wouldn't have two income streams, you'd have one. But there's a bigger issue. Portfolio income is subjected to another tax called net investment income tax. It's 3.8%. So 3.8% on $200,000 of income is real money. Distributions from an IRA are not subjected to net investment income tax. So at a minimum, we save them $7,000, right? At a minimum. But once you get to the age, and these clients are of this age, that's why I'm telling this story. Once you get to mid-60s, and especially RMD age, don't hold interest-bearing things outside the IRA. Because it gobbles up really valuable space in the tax bracket, and even when it's tax-free interest, it enters into the Medicare equation, right? Because in my experience, most people who have an allocation to fixed income, they aren't necessarily spending it. They just want a portfolio that has a mix of fixed and growth and weight, right? And so where it gets held becomes more important later. We want slower growing assets in the IRA because to ward off the RMD problem, it's not subjected to net investment income tax, et cetera. Make sense? All right, so here's Bob and Sue. We're almost done. What I'm pointing out here is this tax-exempt interest could harm them in the IRMA calculation if they're that high. This taxable interest, depending on their level of income, could be subjected to another tax or gobble up valuable room. The spread between these two numbers, once again, these are all little numbers, but I had one earlier in the week where the dividend amount was $120,000 and the qualified was only $50,000. So it was $70,000 of income there, okay? So taxable pensions, Gross Social Security, taxable Social Security, short-term loss, blah, 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 blah. Okay, so here's what happens. Their total income is $212.90. Remember that. So as we go along here and we see that they're only in the 22% tax bracket with a lot of room, about $56,000 of room in that bracket, okay? But if I scroll down here to the Medicare stuff, look where they landed. 2017 and $90. So they're over the threshold by $5,000, $5,090. Almost all of that is coming from the tax-free bond interest. And the bank account interest and the ordinary dividends. Those items alone will end up costing 74 times 2 plus 14 times 2 every single month. It's a big deal to most people. But there's another thing I want to show you. And that is this. When I get down to there's two things here. These folks were giving cash to charity. Their total itemized deductions were 28 and change, but the standard deduction was 30 something. So I'm not saying don't support a charity unless you get a tax deduction. I am saying that if you're supporting a charity and it isn't winding up with a tax deduction, we should think about how to bunch it or strategize how to do a larger contribution at one time that can become deductible, and then you can dole it out to a charity over time. Like some people will say, I'm going to give $10,000 every year to the church, and I say, okay, could we do 50 now and dole it out to the church 10 at a time over the next 5 years? Because the donor advised fund will let you do that, and then you get a deduction for it, whereas this won't allow for that. And the other thing is people give cash to charity all the time, and I want to teach you about charitable swap. So if I have $100,000 in Apple stock, but my basis in it is 10, I have a $90,000 capital gain. This is a real scenario. I had this last week. Is it worth $100,000 to me? No. Because there's no way to convert it to cash without the friction of taxes. So if I sell it, I'm going to pay tax on the capital gain. So this client wanted to give $100,000 to charity, and they were going to give $100,000 cash. And I said, no, let's talk about this. Why don't we give $100,000 of Apple stock to the charity? Because what will the deduction be? $100,000. Even though it's not worth $100,000 to me, I'll still get that value. And then I'll take the cash that I was going to give and buy back Apple stock. Because I reset the basis and I engineer out a capital gain. So not only did I get the deduction I wanted, I engineered out 23.8% on 90 grand, which is $20,000+, right? So it's not what to do, it's how. And then lastly, and I'll stop talking here, I want to show you their deductions. This is this current year. So notice that this enhanced senior deduction, which I told you is $6,000 per person, so $12,000. It's whittled down to $4,500 for this couple because their income is over the threshold and it's gradually being phased out. So the easiest way to mitigate how much of that we cannibalize is moving the lazy interest and all that stuff out of the equation. Okay, so I'm going to end here with just a couple comments. Managing brackets is fruitful because the opportunities are created and expire every single year. And tax law changes more frequently than any other kind of law. The reason is most tax law changes go through a process called budget reconciliation. And budget reconciliation, which is what Tax Cuts and Jobs Act went through, is an example of you can make a change to the tax law with a simple majority in the Congress instead of a 2/3 vote or 60 votes in the Senate. You can do it as long as it's not permanent. It has to come with a sunset. So what happens frequently as this power shifts, you see different things being incentivized and tax laws change to reflect it, and they're temporary. So tax law changes quite frequently, and so do markets, of course, and your family and so on. So those things make managing brackets really, really fruitful. But also, now we have these other things that come into the equation that don't coincide with a bracket. Medicare being one of them. Those are really thresholds where a new tax comes in at a certain level of income, but it didn't change your bracket. And the same thing is true for the senior enhanced deduction, et cetera, et cetera, et cetera. I could go on and on and on and on. I love this stuff, but what I wanted to tell you is more important than anything else, you have a lot of control in this space. Thanks very much. I'll stick around for questions if you have them.
I have
Yeah,
like
okay.
comments to make. This Holistiplan that Matt's been sharing with us is, you can see how detailed and granular it gets with the details with all the different tax ramifications that come with that. But as we talk about Roth conversions and things like that with some of our clients, I know you mentioned it's really kind of there to help benefit the next generation, but also when you think about
yeah.
required distributions going up with growth, that could bump up a client into a higher tax bracket too. But as we use this tool to illustrate those Roth conversions, we can see how it could potentially increase the capital gains or the Medicare premiums and all of those things. So it's not just like there's different tiers involved with that. It gets really in detail, and this is a wonderful tool. And
I'll throw in one other comment too. It's more common now, so we've got some younger folks in the room too. What if somebody stays home to raise a child, right? Temporarily, the household income might be lower. That's a time to convert because it costs less to do so, right? Or somebody takes a sabbatical or somebody starts a business and they're gonna have a net operating loss for a couple of years. We have to think about how to use that time and space strategically because we tend to operate on defaults. Like, I contribute pre-tax and I always contribute pre-tax. But if a lot of my income is bonus driven, like anybody who might be in a sales position is, and you have a particular year where you don't get a big bonus, you've got to think differently about it.
right,
Strategic.
absolutely. And it's not just Roth conversions, there's so many tax planning scenarios that we can get involved to, that we've never had access to this tool before. That was a big decision maker for us, that we're able to do that, because it's such a big part of financial planning and keeping money in your pocket versus Uncle Sam's, so.
Awesome. I think we kept it right to an hour, so thanks everybody. I'll hang around if you have questions. I'm happy to answer them. Thank you guys for having me, and thanks for spending your evening with us.